Equity crowdfunding is best for high-growth startups that want to avoid debt but stay in control of their company. It's also one of the few financing options available to the cannabis industry, which can't legally receive large investments. In this video, we will check out how to equity crowd. Before starting the video, please subscribe to the channel and click on the notification icon so you get notified when we upload the next video. 8. What is equity crowdfunding? When you're looking for financing to start or grow your startup, you might not qualify for traditional loans or be able to find a venture capital firm willing to invest in your business. With equity financing, instead of borrowing money from financial institutions, you raise capital from private investors in exchange for equity, debt, or revenue share. But these don't have to be Wall Street level investors. Anyone interested in investing in startups can open an investor account on an equity crowdfunding platform and be a part of your startup's success story. 7. What are the different types of crowdfunding? Equity is just one type of crowdfunding. Each type has its own particular characteristics. Rewards crowdfunding, debt crowdfunding, donor crowdfunding, equity crowdfunding. Find the right financing for you. Don't waste hours of work finding and applying for loans you have no chance of getting. Get matched based on your business and credit profile today. With reward-based crowdfunding, entrepreneurs don't have to pay back the funds raised. Instead, you give backers some incentive or thank you gifts like early access to your product, a company-branded t-shirt, or even a trip to meet you and your team. Indiegogo is one example. The incentive should be commensurate with the level of donation. The money you raise this way will be taxable. Debt crowdfunding. This one is a bit like a business loan in that your company borrows money that you have to pay back. But rather than borrowing from a traditional lender, your campaign is open to the general public, and private investors can contribute towards the total amount you're trying to raise. A popular example is Kiva, which offers 0% loans to small businesses through a form of debt crowdfunding. With donation-based crowdfunding like GoFundMe, you don't have to pay the funds back at all. Backers donate to your business or cause. This can be a good option for nonprofit organizations. Donation levels may include perks or rewards, but that's not required. So why equity crowdfunding? It may be that one of these other types of crowdfunding is a better fit, but bringing on investors can carry benefits we'll go into shortly. 6. How does equity crowdfunding work? Imagine you're going to Shark Tank and you want Mark Cuban to invest in your startup. Now imagine that instead of pitching to sharks, you're pitching an entire audience of prospective investors and asking each to put money into your company. That will give you an idea of what it might take to be successful in raising funds on equity crowdfunding platforms. Even if you're not gearing up to pitch an investor on national television, the more prepared you are with answers to questions potential investors will have, the more money you can raise. You can be sure that private investors on crowdfunding platforms or elsewhere will want to know how you will use the money you raise, your profit margin, your cost of goods, your target market, what makes your business unique. Investors will want to understand why you are qualified to run and grow your business. You will need to come up with research on your industry, competitors, and future growth of the market in addition to the typical business plan and financial projections for loan applications. And you'll need to be able to answer questions such as those above in order to attract investors. Once you've submitted your crowdfunding application to a crowdfunding platform, it will be reviewed. It's up to you to create a campaign that is appealing and informative for investors. Engage through photos, infographics, and videos as well as ample data. Anyone signed up as an investor on the platform can invest in your campaign. You may not receive any funds until you meet your goal, so be aware of that when setting your fundraising goal. While the basic investing procedure is the same, equity crowdfunding platforms do operate in different ways. Some charge investors processing and other payment fees, while others take their compensation out of the money the company raises, a percentage cut of a company's capital campaign. They also screen companies differently. Some platforms basically list anything. Others, more exclusive, present thoroughly vetted deals. Some provide a lot of intel. Others call on investors and do additional research themselves. Some stick to tried-and-true industries. Others feature less traditional enterprises, like a new indie film. 5. How does equity crowdfunding work for investors? From the investor perspective, the process for equity crowdfunding is a bit different. You can sign up as an investor on crowdfunding sites like Start Engine. Some may have criteria for who can be an investor and how much you can invest annually. Once you find a crowdfunding campaign you're interested in, you can invest in it. There may be a minimum investment, so check that first. Also, carefully read through all the material on the campaign so you understand if you're getting private equity, revenue share, or something else. 4. How the equity crowdfunding process works for entrepreneurs. Crowdfunding transactions must be conducted through either an online platform that's registered with the SEC and the Financial Industry Regulatory Authority, FINRA, or a broker-dealer. While each equity crowdfunding platform has its own process, entrepreneurs typically follow these steps to set up a campaign. Apply to set up an account with the platform. You may need to provide financial statements for the business and all owners, directors, and officers, as well as a business plan and a pitch deck. Submit your initial paperwork to the SEC once you're approved, with the platform's assistance. Set up a campaign on the crowdfunding platform. Set a fundraising goal and determine an end date. Some platforms offer marketing services for a fee. Wait for potential investors to view and fund your campaign. You can share your campaign with friends, family, and other members of your social network. Close out the campaign at the end date and pay the platform fee, usually a percentage of the funds raised. Wait to receive your funds and be ready to be patient. The SEC requires businesses to wait at least 21 days between submitting Form C and receiving funds. Regulation A+ campaigns take even longer. Submit any additional documentation to the SEC as required. Most platforms offer services to help you submit the documentation for Regulation Equity crowdfunding, and some will even foot these costs up front. But you may need to rely on your business's own accounting and legal resources for Regulation A+. 3. How much money can you raise with equity crowdfunding? There are a couple of different types of equity crowdfunding, formed by President Obama's Jumpstart Our Business Startups Act, JOBS Act, and each has its own limits for how much money you can raise. With regulation crowdfunding, startups can raise up to $5 million each year. With Regulation A+ crowdfunding, you can raise up to $75 million a year. Depending on how much you want to raise, make sure the crowdfunding platform you're considering will allow you to set up a campaign under the appropriate regulations. 2. Which are the major equity crowdfunding platforms? Here's a list of a few leading players in equity crowdfunding. WeFunder. This is the largest equity crowdfunding site and top funding portal in terms of capital raised. It offers notable transparency in terms of investment results, but does not require featured companies to be focused in a specific industry. Start Engine. As the number 2 funding portal in terms of capital raised and the number 1 ranked portal by number of deals, Start Engine specializes in technology companies. Republic. In 2019, Republic became the 3rd largest platform in terms of capital raised and stands apart because of the extra due diligence required for startups to get approved and featured on its site. Seed Invest. This site also emphasizes how highly vetted its offerings are. They're a diverse lot too, ranging from financial apps to sports gear to biotech. Net Capital. This platform has a strategic partnership with Techstars, a startup mentor and company for investment and innovation. Microventures. This platform's a generalist, but known for some savvy picks. Past investment opportunities it's offered has been from such firms as included Slack, Pinterest, Uber, and Lyft. Next Seed. Investments are focused on ventures that support the growth of local communities, existing small businesses, startups, and commercial real estate. 1. Tips for successful equity crowdfunding investing. Be aware that equity crowdfunding is a business. You're investing money, not donating it, as you do with regular crowdfunding. As such, it behooves you to be careful. Here are some things to bear in mind. Be aware of the risks. There are usually young firms with not much of a track record. The fact that you're not publicly listed means they are unregulated and therefore can be less transparent. Also, your money is less liquid here than it would be if you invested in traditional stocks, ETFs, or mutual fund, which trade daily and have posted prices. Always go through the platform. Beware of companies reaching out directly to seek money from you. All transactions should go directly through a credible SEC and FINRA registered platform. In fact, many companies use the platform to communicate and solicit investor feedback, with platforms like Republic allowing businesses to regularly survey their many small investors. Think long-term. Think of equity crowdfunding as a speculative growth investment rather than one that will offer a current return. With so much uncertainty surrounding early-stage businesses, it's nearly impossible to predict which will or will not succeed. The amount of time it takes to see a return varies significantly, depending on both the type of investment and the company's success. Do let us know in the comment, what do you think? Is crowdfunding a good idea? Thanks for watching.